Yeah, no, I think we're headed for a bear market. And because of the dimension of the bubble, I think the bear market could be more serious than 2007 to 2009, which was painful for the guy in the street. Even if he wasn't in the stock market, it was painful. This time it should be worse. But what our unorthodox methodology is telling us is this is no good. This is over. The bubble's over.
There's a lot of pain to come.
And I think gold is going to go vertical, and I think silver and the miners will go more vertical than gold. It was essential because NASDAQ 100 is the leader index. It led on the upside. It doubled the S&P since 2009, in terms of gains. And it will lead the downside. And it broke a couple weeks ago, lagged to the S&P, but now I've got a full breakage of the key indices. As far as I'm concerned, the market is topped. The only issue now is not whether it goes down, but in what manner. You know, I think it's going to be layers. I don't think there's a crash. Uh, and anyway, but I think it's a very important factor because when you bust a big bubble like that, the money goes somewhere. It always does. You go back through history and look at where did it go when the stock market topped in 29 or mid 70s or the dot-com top or the 2007 top, where did it go? And if you look back, it went into T-bonds and gold related. And this time gold is clearly advancing. It's been advancing the whole time anyway. And it's going to pick up steam now, I think, because the capital flow looking for some other place to be is going to accelerate. And gold is clearly the standout. No, I think we're starting a bear market. And the reason is that the prior breaks that you've seen over the last few years, since the 2022 low, for example, when we had the serious downturn, since that low, there's been an upward process in price and in long-term momentum metrics, like quarterly momentum we look at. It's when we measure each monthly bar in its relationship to a three-quarter moving average. Not overlaying the average. Frankly, I don't care if you're above it or below it. Sometimes that doesn't matter. It's the structure that the momentum chart builds that is distinctly different from what you see on a price chart. So when you see the price chart, you see these breaks, and sure enough, some of them turn back up. But when you look at a momentum chart, you're not just having a break. You just blew floors that go back a couple years on momentum. So we have a structural break that says, no, we've topped. I think you're going to get rally points. I can see one that's maybe about 2% below today's low. Ignore it. A possible bounce point that might be more noticeable is when we return to the 2021-22 price highs. NASDAQ peaked in late 2021 just below 17,000. NASDAQ 100 I'm talking about. S&P peaked in February of 2022 at around 4,800. Okay, so that's considerable percent further down, but it's not a crash. We're talking still, 10% or so below where we are now. And I think you're going to get there. And that may be a bounce point that people start to cheer about. Ignore it. It won't hold. It's just an inflection point. In any trend, up or down, you're going to have counter trend moves. And it takes a while to convince the guys that are on the wrong side now that move is not real. It's counter trend. You know what I mean? And so I don't think rallies now are salvageable situations. They're to sell into. But I do think there'll be bounce points, period.
Okay, and this is what I want to find out right now. Like if the S&P's at 5,600, do you think we're getting ready for a short-term bounce here? Maybe back up to 6,000
Somewhere
or
below 5,500, I might see that's below today's low by 1% or 2. And same with NASDAQ, about 1% or 2 below today's low would be my trading guess for a bounce point. Something that may last 3 or 4 or 5 days or something. A more significant bounce point is where I said, and it's not just because if you look at a price chart and you see the old highs of 2021 and 2022. So if you're a price chartist, you say, oh, we're back on the old high. Let's buy it. Okay. That'll be part of the motivation. But there's some momentum reasons to expect a bounce point there too. So what I'm saying is right now, if you get a bounce, I don't think it's from here. I think it's a couple percent below here. That should be fairly trivial. A more significant bounce, not in terms necessarily of the upside dimension of the bounce, but in maybe it's holding for a while, is closer to where we were back at the peaks, 2021, 2022, which is another 10% or so below where we are now. So, but I don't see a crash situation. Crash is, if you go back and look through history, 35% or so in a matter of a couple of weeks. 29, 87, COVID. COVID was a good example of a crash event. But usually bear markets don't start with crashes. 29 was an exception. Most like the dot-com top. No, there's no crash. Went all the way down to hell, 82% drop in 2 years in the NASDAQ. But there never was really what you can define as a crash. So I don't think we're going to have that phenomenon.
So this is going to be more like 2000, where on the
Yeah.
S&P down 50% in 2 years.
Yes, usually, if you look back through history, usually bear markets last 2, 3 years, 29 to 32, 2000 to late 2002, 70, early mid 70s to 74. That was like a 2, 3 year thing. And it ended in a crash, by the way. That bear market actually ended with a crash, didn't start with one. And then the 2007 to 2009, that was a 2.5 year downturn. And late in that bear trend, a year off the high, there was actually a crash event where the S&P went down in 1 month, it went down over 30%. But it was already way off its high. It wasn't at the start of the move. And so it's rare to see that at the onset of a bear market. But we've had enough breakage in the last, well, actually a month or so ago in the S&P and now with the NASDAQ a couple of weeks ago to argue breakage is serious. It's the onset of a bear market.
And when you compare this market cycle to the early 2000s or the tech bubble, okay, we had, oh man, there were some massive haircuts back then. But the poster child then was Cisco, and I think it lost about 80% of its value.
So did
Now,
NASDAQ 100, 82%. Yeah.
yeah, now I would argue it's Nvidia, and that's been a beast of a stock, but it's already down 20%, 25% from its highs.
I
Where
wouldn't be
you,
shocked by $50 on Nvidia before it's over. Wouldn't
okay,
shock me.
so
What was it, 150, so. But you got to look at other sectors, which we look at all of them, because everybody's looking at the Mag 7, mainly the tech stuff and Nvidia. You better watch the financials. They're going to get injured in this, and they've
because
already.
they've been very strong. I'm shocked by how strong these
Look
financials
at the
are.
last few weeks. It's almost a crash event. Banks have just imploded quickly. In fact, the other day when S&P was down 1% or 2, they were down 5%. Some of the big names, Goldman Sachs, Morgan Stanley, all the big name banks were down. Like the least down was like 3% that day. Most of them were down around 5. Okay, so there's debt vulnerability out there. I don't just mean government debt, but in commercial real estate, we're watching. There's some ETFs that cover that area. And the banks, I also think Bitcoin, we've been arguing, is moving almost brother sister like with NASDAQ 100. In other words, it's behaving like a bubble. It's moving up weeks and down weeks generally with the NASDAQ 100. And it's starting to implode. I mean, you've dropped from 110,000 to 76,000. That's massive. Well, the stock, like you said, the S&P and NASDAQ down 10, 12%. Look what it just dropped. And there's a lot of vulnerability there, not just in the highly retail market that it is, but there's some companies related that have gotten involved in it in serious ways that could create headline type events off to the side that people aren't thinking about. Now, I don't want to pick on BlackRock, but we've noted it's the biggest asset manager in the world. Okay. It's also a component of XLF, which is the financial ETF. Now, I scrolled through momentum-wise. I looked at the momentum trends of the top 20 holdings in XLF, and they all look just as ugly as XLF itself does. Meaning, if XLF is breaking down, and it is, the financial sector, technically speaking, in a way that tells me it's going with the high tech stuff. BlackRock look very vulnerable compared to most of them. And sure enough, we were looking at it a couple of weeks ago. It's dropped another $100 since then. And it has a big, it's an ETF, as I understand it, in Bitcoin. They got involved in that. May have been a big mistake for them. I don't know. I don't know if I don't know the fundamentals. Okay. I'm not going to argue that point. I'm just saying that when these type of events happen, everybody's looking at the highly vulnerable areas, the headline areas, but they better start looking at some other so-called peripheral areas. Because when the damage starts, it pops up in places you didn't expect it. And that creates what? An ambush type effect. Oh gosh, I didn't expect that, And when you create that, you create great uncertainty. But certain other areas and places I can't even name, I don't even know their fundamentals, that they might be also connected in some way or manner with a collapsing crypto market. But the crypto market looks like it's going to implode along with the stock market. And already look at the percent drop. Okay. And I know where the price guys are getting real panicked. Now, I've got momentum levels that you're trading at right now by getting down to certain price levels. You look at a price chart and you see in the 73,000 area, there was a lot of resistance before it broke through that. And so therefore, a price chartist will look at a Bitcoin chart and say, oh, this is near support now. The old highs. So you got down under 76,000 today. So you're near what the price guys think is the support level. Momentum says, you don't want to be closing a week out around today's low, for example, even before you get to that supposed price support. So price says, gee, this is a place to buy it. Momentum says, no, you can implode right through that stuff. And that's when the panic will really set in, because if you don't hold that zone on price, which everybody thinks should be support now, they're going to throw their hands up in the air. And it's not isolated, but it's definitely something to watch, because it is moving with the NASDAQ 100, which indicates to me it's a spec bubble.
And so you said the S&P could drop 50%, which we've seen that many times over in history. Yeah. But Bitcoin, what do you think that pullback
I don't
could
know.
be?
It could, nothing would shock me. Not zero, but an implosion, like 20,000 or something, where the whole thing is erased and you have to start
so
over again.
80%.
I don't know. It's just, I have distrust for that sector. Yeah, no, I think we're headed for a bear market. And because of the dimension of the bubble, I think the bear market could be more serious than 2007 to 2009, which was painful for the guy in the street. Even if he wasn't in the stock market, it was painful. This time it should be worse. We also have government debt crisis. So we not only have the mortgage situation back then, now we have possibly commercial credit, commercial real estate having a problem. You can watch those guys via RWR and VNQ ETFs. They're ETFs that hold large commercial real estate firms. We technically watch that. We also watch financial sector, the banking sector, because it's the debt problems that once you break the stock market, suddenly those debt problems pop. And it's enormous. Debt, the credit crisis we're facing, I think, is bigger than we've ever seen. And the stock market breakage will help expose that. And it won't just be a drop in NVIDIA. But what our unorthodox methodology is telling us is this is no good. This is over. The bubble's over.
There's a lot of pain to come.
And I think gold is going to go vertical, and I think silver and the miners will go more vertical than gold.
So let's talk about the price in gold now. In the early 2000s, it went from, I think it was $250.
260-ish to 1,920. So eightfold,
So 8 times. Now, you mentioned that the price of gold bottomed in 2015 at just over 1,000. Can you use the same sort of numbers in terms of a target price?
Twice before in the last 50 years, we've had eightfold moves in gold. Where if you look at a logarithmic scale chart It's the same dimension on a log scale, or instead of an arithmetic point scale. So inhale, exhale, eightfold, eightfold. Huh. If we do eightfold again, we're just doing something we've done twice before. But do we have fundamentals and dynamics right now that are far more explosive or implosive, depending on the market, to drive gold, the monetary metal, money, to the upside, more so. So even throwing out the number 8,000, I'm not projecting that technically. I'm merely pointing out the reality that's occurred twice in the prior two big bull markets in gold. From 1975 to 1980, we went from $103 to 850. Okay. And it took you 3.5 years. And then the other one took 10, 11 years, but you went from, 260 to 1920. Okay. We're starting from 1,050 low. And yeah, we're in the ninth or going into the 10th year now, but I'm not measuring years because the bull markets have different durations. But the dimensionality is, and with the new factors in play, the implosion of the bubble and the movement of money, therefore, and the increase of monetary excess by central banks, therefore, gold's sitting pretty. It's technically ripe. And I think probably you're going to see the move into new highs, as you issue this interview, frankly, in the next couple of days or week. And I think that move is going to be qualitatively different than what we've seen before. Instead of 3 steps up, 1 step back, or silver 2 up, 2 back, it's going to be something far more accelerated. And people will wonder why. And it's because of the other things we've been talking about.